Is FEPI ETF right for you? Watch before you invest. Hey everyone, and welcome back to Chat ETF. Today, we're diving deep into the FEPI ETF, a tech-focused fund promising both growth and income. But is it all sunshine and rainbows? We'll be uncovering the benefits and drawbacks of FEPI, from its exposure to leading tech companies to its unique income generation strategy. Plus, we'll compare it to popular alternatives and help you decide if FEPI fits your investment goals. So, buckle up, tech enthusiasts and income seekers. This is your chance to learn everything you need to know about the FEPI ETF, all in the next few minutes. Let's chat. Question 1. What is FEPI? The Rexfang Innovation Equity Premium Income ETF, FEPI, is an exchange-traded fund, ETF, launched in December 2022, offering investors exposure to the large-cap technology sector, while aiming to generate consistent income. Here's a deeper dive into its characteristics. 1. Investment focus. FEPI primarily invests in established technology companies, similar to the well-known FANG stocks Facebook, Amazon, Netflix, and Google, but with a broader reach encompassing other leading players in the sector. This diversification aims to mitigate risks associated with individual company performance. 2. Income generation strategy. Unlike traditional technology ETFs that primarily focus on capital appreciation, FEPI seeks to generate income through a dual approach. O. Dividends. The ETF receives dividends from the underlying companies it holds, which are then distributed to its own shareholders. O. Covered calls. FEPI employs a strategy called covered calls to generate additional income. Covered calls involve selling call options on the underlying holdings. These options grant the buyer the right, but not the obligation, to purchase the stock at a specific price by a specific date. In exchange for granting this right, FEPI receives a premium upfront. This strategy can generate income regardless of the stock's price movement, but it also limits potential upside if the stock price significantly exceeds the strike price of the call options sold. Question 2. What are the benefits of investing in FEPI? Benefits of investing in FEPI ETF are: exposure to leading technology companies. FEPI offers concentrated exposure to established and influential players in the technology sector, similar to the FANG stocks Facebook, Amazon, Netflix, and Google. This allows investors to potentially benefit from the growth potential of these companies, which have historically been major drivers of market returns. Enhanced income generation. Unlike traditional technology ETFs that focus primarily on capital appreciation, FEPI utilizes a dual approach to generate income. Dividends. Investors receive a portion of the dividends distributed by the underlying companies held by the ETF. This provides a passive income stream, without the need for individual stock selection. Covered calls. FEPI employs a covered call strategy, which involves selling call options on its holdings. These options grant the buyer the right, but not the obligation, to purchase the stock at a specific price by a specific date. In exchange for granting this right, FEPI receives a premium upfront. This strategy can generate additional income regardless of the stock's price movement, offering a buffer against potential downturns. Potentially lower volatility. the covered call strategy used by FEPI can potentially lower overall portfolio volatility compared to traditional technology ETFs. This is because the income generated from selling call options can help to offset any potential losses from price declines in the underlying holdings. This can be particularly appealing to investors seeking a more stable investment within the technology sector. Question 3. How does FEPI generate income? FEPI employs a dual approach to generate income for its investors. 1. Dividends. FEPI invests in various established technology companies, many of which are known for paying regular dividends to their shareholders. When these companies distribute dividends, FEPI receives a portion of those dividends based on its holdings in each company. These received dividends are then distributed to FEPI's own shareholders on a regular basis, typically monthly. 2. Covered calls. FEPI utilizes a strategy called covered calls to generate additional income. In a covered call, FEPI sells call options on the underlying stocks it holds. These call options grant the buyer the right, but not the obligation, to purchase the stock at a specific price, strike price, by a specific date, expiration date. In exchange for granting this right, FEPI receives a premium upfront from the option buyer. This premium represents the income generated from the covered call strategy. Here's a breakdown of how it works here. Scenario 1. Stock price remains below the strike price by the expiration date. The call option expires unexercised, and FEPI keeps the premium as income. FEPI retains ownership of the underlying stock. Scenario 2. Stock price rises above the strike price before the expiration date. The call option might be exercised by the buyer, obligating FEPI to sell the stock at the strike price. While FEPI still receives the initial premium as income, it also misses out on any potential further appreciation of the stock price beyond the strike price. Therefore, the covered call strategy allows FEPI to generate income regardless of the stock's price movement within a certain range. However, it also limits the potential upside for FEPI if the stock price significantly exceeds the strike price of the options sold. Question 4. What are the risks associated with FEPI? While FEPI offers some potential benefits, it's crucial to understand the associated risks before investing here. 1. Limited upside potential. FEPI's covered call strategy can cap potential gains if the stock prices of the underlying holdings significantly increase. This is because the call options sold obligate FEPI to sell the stock at the strike price if exercised by the option buyer. If the stock price rises beyond the strike price, FEPI misses out on those additional gains, even though it retains the premium earned from selling the call option. This can be a disadvantage for investors who believe the underlying companies have significant room for future growth. 2. Lower overall returns. While FEPI aims to generate consistent income through dividends and covered calls, this strategy might also lead to lower overall returns compared to traditional technology ETFs that focus solely on capital appreciation. The income generated from option premiums may not fully compensate for the potential for higher capital gains that could be achieved in a rising market with a traditional ETF. 3. Market volatility. Even though the covered call strategy can potentially mitigate downside risk in a declining market, FEPI is still not immune to overall market volatility. If the stock prices of the underlying holdings experience significant declines, the income generated from covered calls might not be sufficient to offset those losses. 4. New ETF. FEPI is a relatively new ETF launched in December 2022. This means it has a shorter track record compared to other established ETFs, making it difficult to assess its long-term performance with absolute certainty. Investors should be cautious of relying solely on its limited historical data when making investment decisions. 5. Higher expense ratio. Compared to some other technology ETFs, FEPI has a higher expense ratio. This means investors incur a higher annual fee to hold the ETF, which can eat into their returns. It's crucial to compare expense ratios with similar ETFs to ensure the potential benefits outweigh the costs. 6. Reliance on options market. FEPI's income generation strategy relies heavily on the options market. The effectiveness of this strategy can be impacted by various factors, such as changes in volatility, interest rates, and investor sentiment, affecting the premiums received from selling call options. 7. Underlying company risk. Despite diversification, FEPI's performance is still tied to the success of the individual companies it holds. If these companies experience financial difficulties, scandals, or negative market sentiment, the value of the ETF and its income generation capabilities could be negatively impacted. By carefully considering these risks alongside the potential benefits, investors can make informed decisions about whether FEPI aligns with their investment goals and risk tolerance. Question 5. How does FEPI's performance compare to other investments? Comparing FEPI's performance directly to other investments requires specifying a timeframe and selecting appropriate benchmarks for comparison. Here's a breakdown to guide your research. 1. Timeframe. Since FEPI is a relatively new ETF launched in December 2022, long-term performance data is not yet available. Therefore, comparisons should focus on its short-term performance since inception. 2. Benchmarks. Technology ETFs. It's reasonable to compare FEPI with other established technology ETFs like QQQ, Invesco QQQ Trust, VGT, Vanguard Information Technology ETF, or XLK, SPDR SP Technology Select Sector Fund, to understand its performance within the broader technology sector. Income-oriented ETFs. You could also consider comparing FEPI with income-oriented ETFs like DVY, SPDR SP Dividend ETF, or SCHD, Schwab US Dividend Equity ETF, to assess its income generation capabilities against other options. 3. Performance metrics. Total return. This metric considers both capital appreciation and dividend distributions to provide a comprehensive picture of an investment's overall performance. Yield. This metric reflects the annual income generated by an investment, expressed as a percentage of its price. Question 6. Who is the right investor for FEPI? FEPI may be a suitable choice for investors with the following characteristics and goals. Income seeking. FEPI primarily targets investors who want a consistent source of income from their technology investments. The ETF's combined dividend distribution and covered call strategy provide investors with a regular income stream. Moderate risk tolerance. Due to its income generation strategy, FEPI may be less volatile compared to traditional technology ETFs and experience less severe drawdowns during market downturns. Therefore, it might appeal to investors with a moderate risk tolerance who seek exposure to technology companies, but with slightly dampened volatility. Focus on established tech giants. Investors who believe in the long-term growth prospects of large-cap, established technology leaders, like the FANG stocks, may find FEPI attractive, as it offers concentrated exposure to these types of companies. Acceptance of limited upside. For those who prioritize income over aggressive capital appreciation, FEPI can be a viable option. Investors should accept its inherent trade-off. Income generation, through covered calls, potentially limits upside potential in a strongly rising market. FEPI might not be the best fit for growth-focused investors. If maximizing capital appreciation in the technology sector is a primary objective, traditional technology ETFs that don't utilize covered calls may be more suitable. These ETFs provide more direct exposure to the potential growth of the underlying companies. High-risk tolerance investors. Investors who prefer aggressive growth potential and are comfortable with greater volatility may not be satisfied with the relatively moderate risk profile of FEPI. Investors needing flexibility. The covered call strategy employed by FEPI could limit the ability to sell holdings quickly if needed, as there may be obligations to fulfill if the call options are exercised. Important considerations here. Expense ratio. FEPI has a higher expense ratio than some comparable ETFs. This means investors pay a higher annual fee, which could erode returns over time. Short track record. As a new ETF, FEPI has limited historical performance data. This makes it more challenging to assess its long-term potential and reliability.